You probably have a misconception. The petrodollar can usually be explained as an oil story. That explanation is incomplete, and that misunderstanding is why this is worse than most people think. Part 1. You think this is about oil. The real story is not about how oil is priced. It is about why the United States was allowed to live beyond its means for 50 years. It is about why deficits did not matter, why debt did not bite, and why inflation could be exported instead of felt at home. Most people think the petrodollar is fading. What is actually happening is that the mechanism which made the entire system stable is breaking. And once that mechanism breaks, the consequences do not arrive gradually. They arrive all at once. Part 2. The crisis that forced the deal. To understand why this matters, you have to go back to the early 1970s. The United States was spending more than it earned. It was funding the Vietnam War. It was expanding domestic programs. And it was issuing more dollars than it could support with gold. Under the Bretton Woods system, foreign governments could convert dollars into gold at a fixed rate. By the late 1960s, several countries realized the United States did not have enough gold to honor those claims. They started demanding conversion. In August 1971, the United States closed the gold window. The dollar became a fiat currency overnight. That decision solved one problem and created several larger ones. Inflation surged, the dollar weakened, and confidence cracked. Then came the oil shock. In 1973, OPEC imposed an oil embargo, and oil prices quadrupled. Fuel shortages spread across the United States. Inflation spiked into double digits, and the stock market lost nearly half its value. The dollar was no longer backed by gold. And now it was no longer trusted. That was the moment the system should have collapsed. Instead, it was rebuilt. If you are interested in and enjoy this kind of video, please like, share, and subscribe to the We Do All of This channel. Part 3. The Petrodollar Mechanism. In 1974, the United States negotiated a strategic agreement with Saudi Arabia. The deal was simple, but its implications were enormous. Saudi Arabia agreed to sell oil only in US dollars. The United States agreed to provide military protection, weapons, and security guarantees. In return, Saudi oil revenues would be reinvested primarily into US government debt. Saudi Arabia then enforced this standard across OPEC, and from that point on, any country that needed oil first needed dollars. This created three structural outcomes: permanent global demand for US dollars, automatic recycling of oil revenues into US debt, and artificial suppression of US borrowing costs. The dollar replaced gold as the anchor of the global system. Energy became the backing. This is what people miss. The petrodollar was not just about pricing oil. It was about creating a closed financial loop that never forced the United States to balance its books. Part 4. How the dollar became untouchable. Once oil was priced in dollars, everything else followed. Trade contracts moved to dollars. Debt markets moved to dollars, and central bank reserves moved to dollars. By the 1980s, the dollar was no longer a currency, it was infrastructure. U.S. Treasury bonds became the global risk-free asset. Foreign governments parked surplus dollars there. Interest rates stayed low. Deficits expanded without consequence. This produced what foreign officials openly called America's exorbitant privilege. This meant the United States could import more than it exported, spend without raising taxes, fight wars without paying for them, absorb global savings indefinitely. But this privilege came with a hidden dependency. The system only worked if the dollar was neutral, if access was guaranteed, and if reserves were untouchable. That assumption did not survive. Part 5. When neutrality died. The first cracks appeared quietly. In 2000, Iraq announced it would sell oil in euros instead of dollars, and, at the time, this seemed symbolic. Then the euro strengthened. Iraq earned more revenue, and other producers noticed. In 2003, the United States invaded Iraq. Within weeks, oil sales were switched back to dollars, and the message was received. In Libya, a decade later, the challenge was different but more dangerous. Libya held over 140 tons of gold. Muammar Gaddafi proposed a gold-backed African currency, and oil and commodities would be priced outside the dollar and euro systems. This threatened the financial architecture of Europe and the United States. So in 2011, NATO intervened. Gaddafi was killed. The state collapsed. The gold vanished. The currency plan ended. These events were not forgotten but air-studied, and the lesson was clear. Challenging dollar settlement carried existential risk, but holding dollars carried a different kind of risk. Part 6. The Russian line was crossed. That risk became undeniable in 2022. Russia held roughly $630 billion in foreign reserves, and a significant portion of those reserves were frozen by Western governments. For the first time, a major economy learned that sovereign reserves were not sovereign. This was not a sanction. It was a precedent. The immediate reaction was panic. The ruble collapsed. But something unexpected happened. Russia redirected energy exports. Trade shifted toward China and India. Settlement moved into local currencies. The ruble recovered. By the end of the year, it was one of the strongest performing currencies globally. The lesson spread faster than any speech could. Dollar reserves were conditional. Access could be revoked. Neutrality was gone. Part 7. China builds the exit ramp. China had anticipated this new world. In 2018, it launched yuan-denominated oil futures, and these contracts were linked to physical gold. This created a silent but powerful loop. Oil sold for yuan. Yuan converted into gold. Gold held outside the dollar system. No U.S. banks, no SWIFT, no exposure to sanctions. China did not demand abandonment of the dollar. It simply made avoidance rational. At the same time, China expanded currency swap lines, built alternative payment systems, and accumulated gold quietly. This was not ideology but a balance sheet defense. Part 8. Saudi Arabia stops playing. Exclusively. Saudi Arabia sits at the center of the oil system. For decades, its alignment with the dollar was unquestioned. However, that changed with this timeline. In 2019, Saudi oil facilities were attacked, and the United States did not respond militarily. The security guarantee weakened. In 2022, China's president was welcomed in Riyadh with full state honors. He publicly called for energy trade in yuan. In 2023, Saudi officials stated they were open to settling trade in multiple currencies. Saudi Arabia later joined the BRICS framework. There was no announcement ending the petrodollar, but there did not need to be. Once oil can be priced in multiple currencies, exclusivity is gone. And once exclusivity is gone, the system behaves very differently. Part 9. Gold tells the real story. While currencies shifted, central banks acted. In 2022, central banks bought over 1,100 tons of gold. Then, in 2023, they bought over 1,000 tons again. The buyers were not Western nations. They were China, India, Turkey, all emerging economies. At the same time, regulatory rules quietly changed. Physical gold was reclassified as a Tier 1 asset, equivalent to cash. Gold was remonetized without announcement. This is not nostalgia, it is preparation. Part 10. The U.S. debt problem is no longer hidden. While the external system fractured, the internal math deteriorated. The U.S. national debt surpassed $35 trillion, and when interest rates rose above 5%, servicing costs exploded. By 2024, interest spending exceeded defense spending, Medicare, and interest moved toward becoming the largest budget item. Foreign demand for U.S. debt weakened. China reduced holdings, Saudi Arabia increased gold purchases, and Japan struggled to defend its own currency. Increasingly, U.S. debt was absorbed internally. The recycling loop stopped working automatically. Part 11. Why this is worse than you think. Most people think this ends with the dollar collapsing, but that is not how reserve currency systems end. They end with fragmentation. Trade becomes regional. Settlement becomes political. Supply chains prioritize trust over efficiency, and real assets matter more than paper claims. The dollar still exists, but it no longer absorbs global pressure. So inflation that once leaked outward stays home, power becomes expensive again. Deficits matter again, and limits return. Part 12. The closing reality. The petrodollar was never immortal. It was a crisis solution that lasted 50 years. It allowed extraordinary prosperity by externalizing cost and risk, but those conditions no longer exist. The world is not rejecting the dollar. It is building around it. And once alternatives become viable, dominance fades quietly. This is not the end of money. It is the end of a privilege most people never realized they were living under. And that is why this is worse than you think.